This is the Technology and Transitional Energy VSA podcast on Thursday, the 30th of January. Andrew is on a business trip, and I, David Scriven, are joined by Phil Smith, who is currently in the vicinity of the Oxford Cambridge Growth Corridor. How are you, Phil?
Very good, David. To be precise, I'm in Newmarket, so yes, indeed, very close to Cambridge.
Anyway, so when we do it together, I tend to have a little look at the USA. But of course, there's been a lot of news there, so it may not be just a little look, but I'll kick off anyway in that vein. So, the Federal Reserve Chair, Jerome Powell, made clear that the US Central Bank intends to hold interest rates in a range of 4.25 to 4.5% for the foreseeable future. The Fed's rationale is based on uncertainty over how President Trump's policies, immigration, tariffs, fiscal policy, etc., could impact their expectations for the economy. The next meeting is March, and investors are fully pricing in a first cut by July. So the market's focus will be very much on the earnings season upcoming. With investors marveling at DeepSeek's apparent ability to build an innovative and innovate an AI model without spending nearly as much as rivals, raises questions on how they managed it and what it means in the US tech race with China. Now, while China has a deeper pool of highly skilled software engineers, a vast domestic market, and government support in the form of subsidies, the country is still playing catch up in terms of advanced AI chips, US export curbs, and access to ASML's extreme ultraviolet lithography. DeepSeek is reported to be using less advanced Nvidia chips, and Microsoft and OpenAI is investigating whether data from OpenAI was obtained in an unauthorized manner by a group linked to DeepSeek. DeepSeek's open source, it allows other companies to build on top of it. R1 release is a wake up call which highlights potential access to less expensive AI advancement, but also endorses and potentially charges AI growth. With lower cost and potential lower pricing, the valuations of industry players were put into question on Monday. Lofty valuations had made early stage OpenAI model lookalikes a tough ask, but now that may change, with a caveat that all new entrants need a robust revenue model when they don't have the proprietary data like the Microsofts of this world have in terms of end users and ad pull. Furthermore, the market is now questioning AI spend, and I'm wondering if the key is in the target market. The enterprise market may raise AI budgets in recognition that more advanced chips are going to reap more and more rewards in enterprise cost savings. Enterprise has gone well beyond document processing to serving entire organizational objectives, which is now being dubbed agnetic AI. On the DeepSeek sell-off, I note the following comments from CEOs. ASML announced a very strong Q4 fueled by the AI boom and booked more than twice as many orders as analysts expected in the period. Now, the CEO brushed off concerns about lower cost and opined that lower cost meant AI could be used in more applications, and more applications mean more chips. And I think, Phil, you'd like to add a comment in there.
Well, yeah, David. No, thank you very much for the comments on DeepSeek and the observations there. And obviously, yes, it certainly had an impact on prices near term. And it did for Nvidia's price, which was hit with a sell off and has certainly recovered somewhat from it. And I'm kind of much of the mode of this is still very much an emerging market for applications and technologies. It's early days. And we're going to see competing solutions come out of the woodwork, but very often the cheaper the better. in terms of their attractiveness to the markets. But let's see how things evolve. I would stress very much it's very much we're at an early stage in growth in AI. Yeah, ASML very much benefiting from this. I mean, ASML make the the photolithographic machines that are used to define the structures on silicon chips. They make the most advanced equipment in the market. And are clearly benefiting from customers such as companies such as Nvidia, who use TSMC to make their silicon chips. But ASML's Q4 trading update, which you've noted, I think was ahead of analyst expectations in terms of the profitability for the quarter and also their outlook for Q1, particularly looking at the bookings that they've received, because there's been a lot of concern in the market that the US restrictions on exports into China of ASML equipment. But there were stronger bookings than expected in orders, so that was good news for ASML. Yeah.
Indeed. And then quoting from other CEOs, just to get guidance from them, I noted that Mark Zuckerberg of Meta exuded confidence in his company's AI strategy, saying that 2025 will be a really big year in which its AI assistant will become the most widely used in the industry. He believes that Meta will eventually spend hundreds of billions of dollars on AI infrastructure, imitating and improving on the best technology presented by competitors to ensure its dominance. The remarks sent the shares up in extended trading following disappointing sales forecasts for the current quarter that had originally weighed on the stock. Q4 sales were 48.4 billion, beating the street, but the Q1 outlook was 39.5 to 41.8 versus the street midpoint of 41.7. Meta is open source like DeepSeek, and Zuckerberg flagged Meta will be able to reduce costs, which could address some of the concerns raised by analysts about the Chinese competitors' lower spending. Now, the Microsoft boss, Satya Nadella, said its multi-billion investment in AI infrastructure remains necessary regardless of DeepSeek's claims to have trained its research model for about 8 million. Despite EPS ahead of the street for the quarter, the share price fell because the cloud computing business missed forecasts. Now, Tesla's results disappointed, and the company sold fewer cars um, in 2024 than in 2023. But its shares went up when Elon Musk talked about AI, robots, and robo taxis. Sort of trying to synthesize this, I'm thinking that the tech giants are going to need to justify the need for spending big on data centers and cloud computing if investor concerns on research models being trained for a fraction of the previous cost. And Elon Musk's political prominence is perhaps overarching a transition from an auto pure play to a diversified play on AI and robotics. The AI ETF has almost recovered all its DeepSeek sell off, whereas the SOX semiconductor index is circa 10% off from the high and the sell off. Other things to look out for, I think, in the earnings season are Qualcomm, who will report on the 5th of February. Look out for handset revenue upside as the Samsung S25 smartphone features Snapdragon chipsets across all variants. This compares to the previous generation S24, where Samsung's in house Xenos chipset was used in models outside of North America and China. This highlights Qualcomm's technology leadership in mobile processors, which is extending further into other end markets, including the Internet of Things and autos. And finally, I'll just comment on a quick comment on clean tech, an overarching point which won't have escaped investors, but political uncertainty is likely to overhang on the sector in the early part of 25. The market does not expect full scale repeal of the Inflation Reduction Act, but executive orders have directed government agencies to halt all payments under the IRA and the Bipartisan Infrastructure Law, the BIL, for the next 90 days. The administration has been targeting EV incentives, and this could have an impact on EV sales and a knock-on effect for the EV charging. I note BNEF expects 9 million fewer EVs to be sold and project a 33% penetration by 2030 versus a prior 48%. While there is more bipartisan support for hydrogen, but project developers also face clarity from the Trump administration and higher production costs. So, Phil, with that, I would ask if you kindly take us to the UK and maybe talk to us about Ceres.
Yeah, sure, David. Well, thank you for that comprehensive overview. Ceres Power, and we're on the subject of hydrogen, transitional energy. Ceres Power, the ticker is CWR. Market cap's £283 million. And this Ceres have been listed for a long time. Developer of solid oxide electrolyzer cells and solid oxide fuel cell technology for distributed power. So this is all about using hydrogen to power those fuel cells. The Ceres Power shares are down 30% over the last 12 months, and sentiment towards hydrogen and renewables, as Andrew and I have covered, has not been good, and David's overviewed some of the things that are happening in the States on it. Anyway, Ceres have issued a trading update for the year ending December 2024. They've commented that they're seeing record order intake of greater than £110 million, and this is due to 2 new manufacturing partners that they've signed up for their electrolyzer technology. Their revenues are expected to be at the upper end of previous guidance of between £55 to £60 million. Gross margins are expected to be higher as well, 78% to 80% this year versus 61% last year, so that's very encouraging. The company, it's been making losses, it's reducing its costs, and it said it's expecting to reduce its annual cost base by 15% going forward. Unfortunately, it does have plenty of cash and has cash and short-term investments of £102 million. So that was Ceres Power, and that's something I also noted in this, is that their licensing strategy is making good progress as well. And in Taiwan, they have a new partner, Delta, who is progressing towards manufacturing. So that's good to see them making good use of their IP, and it will be a higher margin model if they are licensing the tech. Okay, so that was hydrogen fuel cells. Moving on to this is detector technology, Kromek. David, I don't know if you've come across Kromek before. Ticker is KMK. Shares are up 40% today. Company has again been long listed. It listed, I think this one listed in 2014, so just over 10 years ago. And they have intellectual property in CZT detectors. This is cadmium zinc telluride detector technology that they have developed. The company, UK based up in Durham, very IP rich. They have 240 patents for its technology. And it's been selling, in the last few years, selling into the chemical, biological, radiological, and nuclear CBRN detector market. What's that all about? Well, these are detectors for threats from bad actors using chemicals or nuclear radiation. So selling into that market. But it's also developed this detector technology for scanners used in healthcare, particularly what are called SPECT scanners. This is single photon emission computed tomography body scanners. These are body scanners that can create images of your internal organs in hospitals. So two big markets for it. As I say, the company has been loss-making. Its last set of results, the revenue was up by 12% to 19.4 million, but its EBITDA loss was 3.1 million, and it had to go through a debt financing as well. However, it has had some very, very good news, and it's announced today that it is to provide Siemens Healthineers, and Siemens are a big maker of scanners, over a 4-year period with know-how to use rights of IP on a non-exclusive basis for its furnaces and services to produce CZT detectors for medical imaging. And under this agreement, it's going to be paid $37.5 million in cash in 4 installments. First installments of $25 million to be received in the current financial year, and obviously it will have a material positive impact on the business. So very, very good news indeed there for Kromek, and the shares are up by 40% today. It goes to show that technology does take a long time to develop often, and a long time to reach its markets. But if you've got very, very strong IP and something very, very different, you can be highly successful, which they are now being. So that was good to see, David.
Yeah, I wasn't familiar with that name, so that was very interesting. And also noted the volume was huge. So I did a double take on that. I had to go and double check it.
Yeah. Oh yeah, yeah, quite a significant agreement. So just moving on, pressure technologies. This is actually, well, I have to note here that Andrew holds shares in Pressure Technologies, and we use that for the company. Ticker is PRES. Market cap is £15 million. Shares for Pressure Technologies are up by just over 20% in the last 12 months. This is an engineering business, very long established, long quoted. It disposed of its PMC business. This is a business was machining parts for the oil and gas industry. It disposed of that earlier, well, in fact, it was last year. Put the business on a sounder financial footing, strengthened its balance sheet, and has allowed it to focus on its high pressure cylinders, Chesterfield Special Cylinders business. Chesterfield makes cylinders that operate on the pressures of 750 bar, very, very high pressure, very, very large, and are used in defence applications, mainly used in submarines and in ships. The business has been making very good progress. Last year, it won a new contract to supply the Royal Australian Navy for 3 of its Hunter-class frigates, and it has announced this week that Chesterfield Special Cylinders has been awarded a contract to supply pressure vessels to a US defense prime contractor, General Dynamics Electric Boat, who manufacture submarines. And it's the first contract with General Dynamics. And, I would say to get, for a small UK company like this, to get a first contract with a US prime, particularly in submarines, is very, very positive indeed. So that was good news for Pressure Technologies. And just going on to software, Eleco, ticker is ELCO, market cap's £120 million, and their shares are up by 40% in the last 12 months. This is one that Andrew and I have discussed previously on podcasts. Their software is used by the construction industry, operates internationally. It's got customers in Ireland, Sweden, Germany, Netherlands, and the software is used in the design process, in the fit-out process. I believe it's used in procurement and also during the whole construction process. So across the board, companies had a trading update for the year ending December 2024, and they have reported that the revenue is estimated to be ahead by 16% to £32.4 million. Organic growth within that, it's made a number of acquisitions, was 9%. So really strong organic growth. Recurring revenues up by 20% to 24.9 million, and very importantly, cash at period end of 14 million pounds versus 11 million pounds. So really strong cash generation, and in spite of actually making those acquisitions as well. And the company is debt free. So very good trading update from Eleco PLC there. That's in software, and sticking with software, Dotdigital, DOTD, 256 million market cap. And this is software, so we talk about Eleco, that's software for construction. This is software for the e-commerce markets and marketing. So it's e-commerce and customer relationship software. It integrates the two platforms, and it allows the e-commerce companies to do highly targeted marketing, things like targeted email campaigns, so based around consumers' interests in particular. And they've had a trading update. This is a 6-month period to December, and revenue estimate of £42 million, £42.4 million versus £38.7 million in the prior period. So it's a 9% rise on a reported basis, on track to meet market forecasts for 86.2 million of revenue for the year. And what I note here is that they have said they're expecting on that revenue for the full year of 86.2 million, pre-tax profit of 18.1 million. That's a PBT margin of 21.8%. 21%, a really strong pre-tax profit margin. Expected closing cash balance of 45.7 million. So, again, very, very positive trading update. And I think the shares, David, I don't know if you've got it on screen, but on Dotdigital are up on the back of that. And this is a company that's widely held by UK institutions as well. And I think a final one from me, and again, this is software, and this is software for transport this time. Microlise Group. The market cap's £135 million. The shares were up by 28% on Tuesday. And that's after a trading update, obviously a very positive trading update. Microlise, the ticker is SaaS, as in SaaS, and it provides transport management software. And this is to fleet operators, helping them to improve efficiency, safety, and reduce emissions is how they describe it. But actually, what does it do? It helps them to reduce fuel use, mileage travel by selecting best routes, improve driver performance, reducing accidents. The transport industry itself does make very low margins, so you can see why there's a need for software like this, anything that helps lift industry margins. They've got 400 enterprise customers. They operate, again, internationally, offices in France, Australia, and India. And in the trading update, they noted that revenue is expected to increase by 12.9% to £81 million, and of that, 12.9%, 5.9% is organic growth. And adjusted EBITDA ahead of market expectations, which we all like to see, at £11.3 million versus £9.4 million previously, with its margins rising. And they've got ending net cash for the period of £11.4 million. And they've made a couple of acquisitions as well. So, all in all, looks to be a very strong statement. A note for Microlise, it's trading on an EV net revenue multiple of 1.6 times and a PE of 24 times. So, looks to be making very good progress.
Now, it's interesting, you touched on a number of very interesting companies and very good trading updates. And if you look on Bloomberg, analyst coverage is not, there's no depth of coverage. So these are opportunities that could, see more investor interest and potentially more coverage.
Yeah, I absolutely agree, David. I think what's also interesting as well on these is one is construction, one is in e-commerce and marketing, and the other is in transport. And all three across those sectors are doing very well.
Yeah.
So there we are. Right. Well, there we are. That's it from me, David.
Likewise, and thank you very much for your insightful comments. And we'll perhaps wrap it up there and wish everybody a good day.
Indeed. Chat next week, David.
This podcast has been produced and edited by VSA Capital. It is intended for information purposes and not as investment advice. The information is intended for recipients who understand the risks associated with equity investments in smaller companies. Please do your own research and do not rely on a single source when making an investment decision. VSA Capital may derive fees from this content and seeks to do business with the companies mentioned.